How's it going, everybody? I'm about to show you a clip from a conversation that Mark Tovey had with Trevor Hall and Dave Kanzler from Mining Stock Daily. Mining Stock Daily is as the name says it itself. It's a podcast. They upload multiple podcast episodes a day. A lot of news from the space. They interview a bunch of people. They do a much better job than Resource Talks does. So if you were looking to drop one and just follow the other, you know what you should do. But if you want to keep both, which would be my preferred option, you should check them out as well. Now, in this clip that I'm about to show you, they talked about where the economy is headed and how that's going to influence gold as well as gold stocks. Dave Kanzler said that the banking crisis is not being taken seriously enough and that he thinks that physical gold will outperform gold stocks. So that's an important point that he made. It's interesting to listen why he thinks that. Further on in the conversation, they talked about picking junior mining companies and diversification. Where you start, is it top down, is it bottom up, and stuff like that, and how they approach that. That part of the conversation is already posted actually on the Discord server. So in my totally unbiased opinion, you should go to our free Discord server to listen to that full conversation. And if you don't use Discord, just go to resourcetalks.com. That's where I publish the full interviews. I also publish them, as I said, pretty much immediately after they've been recorded. So yeah, here's Mark talking to Trevor and Dave.
Dave, you write a subscription-based newsletter called the Short Sellers Journal. And in that publication, you called back in 2021 the collapse of Cathie Wood's ARK fund. You were bearish on the NASDAQ index too before last year's rout. And you even recommended shorting Silicon Valley Bank 18 months ago. My question is, are you finding it harder to recommend overvalued stocks in 2023 after the sell-off of last year, or do you think there's still froth left in the broad market?
Oh, I think that's a great question. I also published the Mining Stock Journal to cover small cap mining stocks for the most part. In terms of the stock market and valuations, I was just mentioning to someone earlier today, I think stock market investors who are going long right now are whistling by several graveyards, geopolitical, economic, financial system, et cetera. So for instance, the bank crisis that people seem to think may have blown over already. I think what the Fed and the US Treasury did in terms of supporting the depositors of those banks, I mean, they're basically bailouts in disguise. I think it was putting a Band-Aid on a gashing wound. So I think that whole story is just starting to unfold and it's going to get a lot worse. Obviously, it looks like the economy is starting to accelerate to the downside. And we don't have the full effects yet in term on economic activity from the Fed rate hikes, right? It usually takes 12 to 18 months for interest rate hikes to really start to do what they're aiming to do with them. So I think what's going on now and what's been going on since, I guess, October, or really, the fourth quarter through now, we've had a pretty big rally in the markets. And I think it's just a classic bear market rally. And it could be running out of steam right now. I don't know. It'll obviously depend somewhat on the employment numbers tomorrow and how the market perceives how the Fed will react to that. But I do think, so for instance, the S&P 500 is at 4,100 right now. I mean, I could easily see 50% downside from here before that's over. I'm not saying it's going to go down that far, but it wouldn't surprise me if it does. That would make the fall from top to bottom somewhat consistent percentage-wise with what happened when the tech bubble burst. So when the market sold off and went into a bear market between 2000 and I guess it kind of ended in late 2002. And then how far the market went down in 2008, 2009. And that really started in 2007. So we're a year into this. We got at least a year, maybe 2 more years of this.
Trevor, does that summarize your view of the macro picture right now, or would you push back on any of those points?
More or less, I think I am in line with Dave. I maybe defer with him on the time frame of it all. And there's a lot of doom and gloom type of messaging out there. And I mean, even hitting mainstream media right now, which is usually a contrarian thing to be looking at. We are seeing a lot of economic data, even just this week alone. The ADP jobs numbers came in weaker, manufacturing numbers came in weaker. I mean, we're starting to see the cracks hit the U.S. economy. However, keep in mind, I mean, we're almost, in a lot of those data points, we're almost back to where we were in 2021, during the lockdowns and the pandemic. And so I do think to feel the full effects, we're going to have to break through some of those positions and further and fall through to where we were even 2022 before the lockdowns even began. But I do think there's a lot of data points out there right now showing you that actually a recession began. I mean, I firmly believe the recession began last month. With a couple of data points, and I'm sure Dave would say the recession began last year, knowing him and talking to him quite often. But I do think it's in line now. What I'm watching really here closely is the narrative and sentiment, and even in the last week leading up to Easter, we have reached just levels of pessimism and fear-mongering that I have not experienced in a long time. When I'm turning on the mainstream media and they're talking about de-dollarization as if it's already happened or going to happen next week, I think that's getting too hot. I'm not saying it's not going to happen. I just think the time frame is something that's being put out there to strike fear, because that's what a lot of media outlets do. That's how they get ratings. But I think something like that narrative is going to happen, but it will be more of a cyclical reason, not because, one country decided to sell a product using a different currency rather than the US dollar. So there are a lot of things percolating in the system. So I do believe with Dave, I am maybe a little bit more of a contrarian when to think that maybe a lot of this is overdone right now.
So I've got Big Bear and Little Bear then on the call, Brother Santos. In talking of doom and gloom, Dave, in a recent Seeking Alpha article, you wrote, "I believe what is starting to unfold will be 2008 multiplied by 5 unless the Fed and other big central banks print enough money to monetize the fraud in the banking system. But if the Fed takes that kind of action, the dollar will likely collapse." And then you went on to write, "It may take bigger blow-ups for the Fed to act, in which case I'm confident that BlackRock, Citigroup, and Goldman Sachs, among several others, are at risk." End quote. So that's a massive prediction, Dave. Is that something you see happening with any kind of significant probability? And did you choose those 3 financial institutions, BlackRock, Citigroup, and Goldman Sachs, for any particular reason?
Well, we've already seen Citi and Goldman blow up on a de facto basis. That happened in 2008. I mean, a lot of people point to Lehman as the trigger for the great financial crisis. I mean, a lot of things were unfolding before Lehman that pointed to a crisis unfolding. But in most, it doesn't get the attention that it should. But it was really when AIG defaulted on its counterparty status to a bunch of OTC derivatives, credit default swaps that Goldman had sold them. That's what really acted. That's what triggered the Secretary of the Treasury at the time, Henry Paulson, who was the former Goldman CEO, to start taking action and rally Congress to come up with all that money they used to bail out the banks, et cetera, and the Fed started printing money to bail out the banks. Even less well known is that Citigroup ended up taking, and I forget the size of it. It's if you go to Wall Street on Parade, they have the numbers outright, and I didn't know until they dug it up. But Citigroup took a massive liquidity injection from the Fed in 2008. So, on a de facto basis, well, we had a banking system collapse de facto in 2008. It's just they printed enough money quickly enough and got it into the banking system that you only saw a handful of banks collapse, culminating with Lehman. But Citigroup and Goldman Sachs and probably Morgan Stanley also, if the Fed hadn't done anything, and we'd be better off today if it hadn't, and same with the government, I don't know that those banks would be around in their current form today. So, and I threw BlackRock into the mix because, well, you saw the news today about what's going on in France, right? No. The labor unions there took over BlackRock's building in Paris, protesting the lack of pension reform over there, or that, Macron isn't giving them what they want. And they've decided to express their anger by occupying BlackRock. And there's a reason. I mean, you're from the UK. I mean, look what happened to the UK pensions. That was BlackRock's doing, basically. So I think, BlackRock has different risk exposures than Goldman and Citi, but they've got 10 trillion in assets under management. And I think as this bear market unfolds, they're going to lose probably at least half of that, which means it's, if you think that that's going to happen, it's considerably overvalued from here. And I also think eventually you may see massive lawsuits against BlackRock, because I didn't even know this until the UK pension crisis, but they've been busy marketing all kinds of crazy derivative products to pension funds. And I have to assume they're doing the same thing in the US with US pension funds.
Let's turn our focus to gold in the context of inflation. I know that you, Dave, in particular, are a staunch advocate for gold, but I'd like to put the idea to you that if you're worried about inflation, isn't broad equity exposure enough? Because as prices go up, so do companies' cash flows and by extension, their valuations. And for example, Argentina, their inflation rate was the highest in the G20 last year, 100%. But an index of the biggest companies in the country went up 160%. Meanwhile, in Turkey, inflation was 64% in 2022. But at the same time, one index tracking the biggest companies in Turkey was up over 100%. So is that a good enough exposure, just broad equities?
I mean, well, first of all, it's not clear that inflation is going to cause the cash flow at these companies to increase, because their expenses go up as well. And the higher inflation goes, the less consumers can afford. So it's gonna contract real economic activity anyway. So, I mean, depends on how extreme you want to take the example. I mean, the extreme is the Weimar situation, right? With the Weimar government in the early 20s over in Germany, and they hyperinflated their currency for similar reasons that the U.S. has been hyperinflating its currency since 2008. Well, not as so much hyperinflating. I guess we kind of started in 2020, and their stock market just soared, but gold went up even more on a percentage basis. So, and back then you didn't have the mechanisms, the derivative mechanisms that the banks and the central banks have right now to try and keep a lid on the price of gold as much as possible. So, but if you look at the performance of gold, silver, and the stock market, just use the S&P since the beginning of October, gold and silver have handily outperformed stocks. So yeah, you might get a short-term hedge with inflation by investing in the stock market, if inflation continues to roar. But in my opinion, and based on historical examples, I think the precious metals will outperform. And then what happened in Weimar Germany, of course, is the market collapsed, the stock market collapsed, and a millionaire who had, I think they revalued the currency of 1 for a billion marks or something. So if you were a millionaire the day before they revalued, you were a pauper the day after. However, if instead of having all that, your millions in the bank, if you had that in gold, you would have preserved your wealth, because gold preserved wealth perfectly back then, as it has all throughout history.
And talking about gold's performance in market crashes, I was looking at gold prices denominated in dollars over the last 5 market crashes. So a year on from Black Monday in 1987, gold investors were down 19%. A year after the 1997 Asian financial crisis, gold was down 10%. And a year on from the dot-com crash, gold was again down 10%. On the flip side, gold was up 42% a year after the 2008 financial crisis, and it was up 10% a year after the COVID market crash. But overall, gold investors have done worse than cash holders in 3 of the last 5 market crashes. So is it really worth owning it?
Well, the 87 and 97 crashes occurred when gold was in a 20-year secular bear market, right? It peaked in 1980 and bottomed out in late 2000, early 2001. And I think subsequent to that, and actually, during the dot-com bust and that bear market, there was, I got into the gold sector in mid-2001, but the investor audience looking at gold back then was tiny compared to now. And as we find out looking back, China's been accumulating a lot of physical gold for a long time, not just the last 10 years or whatever. So, in a market crash scenario, sure, investors, particularly hedge funds, they're going to dump everything except the kitchen sink. It doesn't matter. They're just trying to, they're levered up, they're on margin. They're just trying to preserve some semblance of net asset value in their funds. So they dump everything. And hedge funds happen to be prolific investors and traders of gold derivatives, specifically COMEX gold contracts. So, if they're dumping those out of their portfolio in a market crash scenario, yeah, it's going to temporarily push down the price of gold. We saw that in 2008. The stock market and gold started heading south in March of 2008 and bottomed out. Gold bottomed out it was late October of 2008. And started heading higher, and the S&P kept going lower and bottomed out in March 2009. So I guess my point here is that, yeah, in a short-term crash scenario, and that's exactly what we had in 87. That was a one-day 25. It was a 25% drop in the Dow. Gold and everything's going to be correlated because everybody's going to be selling everything. But my view is, and my belief, and I think history for the most part validates it, is that at some point during that crash, investors are going to start to look for flight to safety assets, and gold and silver are one of them. And then when those start heading back up, then they'll start moving into mining stocks as well. And mining stocks lagged by a couple of weeks in 2008, and the GDX ETF more than doubled between the early November and the end of the year in 2008, while the S&P was still going lower.
It might also be important to note that, Mark, all of those timeframes and financial moments that you just articulated were after gold was depegged from the U.S. dollar in 71 when Nixon took that off. Now, before that, with from the onslaught of Bretton Woods up through 1971, when the dollar was pegged to gold and in what would be called the gold standard, we didn't have moments of those volatility. In fact, if something were to happen to the dollar, it would also gold would actually react that. But this moments of volatility that you just walked through, after 1971, when the dollar was depegged from gold, gold became whatever you wanted it to. Could it be an insurance asset? Could it be a form of liquidity when you needed it? Whatever an investor wanted, they could use gold for their own purposes. And a lot of those times where you see those big declines of gold is if you're having a market crash or a moment of panic, you're going to look to sell whatever you can. And gold's one of the most liquid assets in the world. So why not just sell your gold when you need to? It has no intrinsic form. I mean, you can, it's a pet rock, yada, yada, yada. You can always buy it back. So you got to keep that in mind, that the system was different in the last 50 years than it was the 50 years previously to that, right? And that's really important to keep in mind.
One other thing I'd like to just add to that is, you're looking at very specific points in time, going back to 1987. If you measure the performance of gold from the beginning of 2001 versus the S&P or the Dow, gold through today, gold has outperformed the stock market over that time period.
A little bit of a lag.
That surprises me.
Well, and you also mentioned, Mark, gold as an inflationary hedge. And I don't know, there's a lot of theories about what causes inflation. Is it the money printing? Well, if it was the money printing, why didn't we have 7-8% inflation in 2008 after QE was originally put into motion? In fact, we didn't have it until QE infinity, when trillions and trillions of dollars pushed inflation up to close to double digits, or more than that, if you're actually looking at real numbers instead of the government numbers. And you can make that, I mean, gold did sniff that out in 2020. It was being bought up as the dollar was falling. But what was different is the monetary policy. Governments were, what this QE in 2020, 2021 was different than 2008 was, in this go around, they were physically giving people money directly into their bank account. So it wasn't this, give it to the banks 2008. Hopefully it trickles down into, the consuming economy. Back then, the banks held it on and bought back their stock. This turn around, the Federal Reserve, the Treasury took that lessons in this QE, and literally you were getting stimulus checks in your bank account as an average person. So if you have this money, you're locked in your house and you're watching a few people using Robinhood, buying, puts and calls, zero dates, and making a ton of money, living on internet 8 to 12 hours a day. That's what you're doing with your stimulus. So I don't think it's necessary. I think you're comparing apples to oranges if you're looking at the gold price relative to the phenomena we witnessed with the equity markets and inflation for the last 3 years. I really do.
I'd like to move the conversation.
I have a quick point of departure from what Trevor said. We did have inflation after from 2008 on. It's just a lot of people weren't looking for it in the right spot. They're looking for it in the CPI. Well, first, we don't have to get into it. There's a lot to unpack there. But the CPI is not designed to measure true price inflation. However, we had a massive inflation in financial assets and in housing prices. And it was the financial assets that captured all of that money the Fed printed, because all of that money went to the banks in the form of reserves. And then, that enabled a massive amount of credit creation. And all that money went into, I'm going to buy a house. I'm going to buy 3 houses and rent 2 out, or went into the stock market. I mean, you had a huge run in the stock market and in housing prices between 2008 and just, a year ago. So, and it was the money printing in 2020, as Trevor pointed out, especially with, that funded the stimulus checks. Then you started to really see that money leak out into the real economy. So, and I think, I think that's why we started seeing price inflation that they couldn't cover up with the CPI any longer. I mean, real price inflation is much higher than what the CPI expresses it as.
All right. Again, it is resourcetalks.com to come and chat, see videos earlier, talk to different people. You don't have to be on Discord to actually join. It is the platform is now on the website as well. You can join as a guest. It's actually pretty cool. If you want to join, you can just do that by clicking open Discord over there. So it is free, and again, there's really no reason for you not to join. But yeah, thank you for watching until the end of this video. Not many people do, so if that makes you feel special, I guess good for you. And I'll see you around.